This is attorney Sarah Holmes, and we are doing a series of videos for the everyday real estate investor. Now, by everyday investor, we're usually talking about people that have jobs or careers, and they're just getting started, or maybe they have already started investing in real estate on the side. So these include people that might be buying and rehabbing and flipping a property, or it could be people that are buying and intending to hold for the long term and maybe have rental properties that they rent out for tenants. So quite a lot of these everyday real estate investors come to us for legal help, and also in the process of helping them, they have a lot of questions about other issues. And one major issue that comes up all the time is financing, and especially as financing relates to setting up a business entity and making their everyday real estate investments into more of a business. So to that end today, we're going to welcome Joe Scorese with Firstrust Bank. He is the Senior Residential Loan Officer at Firstrust and has extensive experience helping investors. So welcome, Joe. Thanks for doing this video for us today.
Thanks, Sarah.
Okay, and can you just introduce yourself to everybody? Just let them know what you do beyond my, brief intro there.
No problem. My name is Joe Scorese. I'm a residential senior loan officer with Firstrust Bank. My coverage is pretty much the greater Philadelphia county and the other surrounding counties in the South Jersey market, going down to the shoreline. Presently, we do residential primary or secondary homes, and obviously we do investment property refinance or purchase scenarios through the bank, whether in the personal name or in the name of the LLC, and I've been in the business since 2001.
Okay, so a pretty long time you've been helping everyday investors and people, looking to buy property.
Absolutely.
Okay, great. So how can you help what we call the everyday real estate investors? People that have jobs and they're just looking to invest in property. How can you help them out?
Well, that's a great question because, when you're working full time, you're trying to find something that's going to be stable and also keep you bankable as an investor. So the word bankable, meaning proper reserves in your bank statements, proper income that matches up against debt, and evaluating the rental capabilities of the property, whether you're going to rehab and hold it or rehab and flip it. You need to understand your exit strategy from a refinance or a purchase perspective, because you want to keep your debt to income, meaning for every dollar you're making, you want to stay under about 43 cents on the dollar. So you want to keep that individual fluid so they don't keep moving forward. Then they run out of proper reserves per property that they own, and also down money, as well as the debt to income on the back end, covering the combined income of you and the subject property.
Okay, so do you help people do that kind of financial evaluation when they're thinking about investing?
You have to at this day and time because the market is very tough and people need to really know what their financial capabilities are. So you got to get a little more involved in understanding what the wingspan is of an investor now. What their financial capabilities are. Properties do not stay in the market very long, so there's not a lot of time to take deep due diligence in certain circumstances. So I had to do a lot of due diligence up front, evaluate their financials, and assure them that they're bankable to move forward on an acquisition.
Okay. And how much time before someone's looking to buy a property, how much time should they allow for that process, or just to get some of those answers?
So if they're thinking about doing something in the next 30 to 45 days, I'd probably say, let's take this application, let's put together this financial resume, let me list you off, let me collect your documents and review them, and assure making offers with a real estate agent, you're going in the right direction. So I'd say, because your credit with me is good to 90 to 120 days. So you have a pretty wide timeline to go evaluate and analyze a property to make an offer.
Okay, so that doesn't sound like a huge lead time. It's not like you have to plan this out a year in advance, 6 months in advance, a couple months.
No.
Okay.
Yeah.
All right, that's helpful. So what kinds of financing can people use if they're going to flip a property? Like if they're going to buy something that's maybe not in the best condition, they're going to get a good deal, they're going to put some money into it to rehab it, and then they intend to sell it pretty quickly. What kind of financing should they be looking for with that?
They should be looking at construction lending options. These are options that typically don't meet a bank or broker environment, meaning It just doesn't, the place won't appraise. It's not livable at the time. So they have to look at a property based on completed value or stabilized value. And that's a tough thing because when you're talking to a real estate agent, they're trying to tell you the list price of the property in the back end, not the true sold and settled comp for the completed value on that property sometimes. So you got to be a little conservative. You got to have a very good contractor on board to evaluate renovations, okay, to the property, because basically, big picture, you're trying to buy the property under 70% loan to value based on the completed value. So if it's a $100,000 value on the back end, purchase and rehab cannot be more than $70,000, or it's going to be out of pocket for you, in a sense. But they're also, a construction lender is going to want to have want you to have a little money in the game because they want to make sure they're not giving 100% financing on the whole project. They're probably going to be willing to go up to 100% on the rehab cost, but they're going to want you to bring about 20% on the purchase side. Okay, so say the purchase side is $50,000 and the renovation is $20,000. I'm going to give you 80% of $50,000. I'm going to want you to bring 20%, which is $10,000. You're also going to be responsible for the cost of closing, which usually is title insurance and it's regulated. There's typically points on the loan amount charged by that type of lender, typically anywhere between 2 and 4 points. So if it's a $70,000 loan, 2 points would be $1,400, 4 points would be $2,800. And also that I would want to see some reserves for the payments because they could range. This is not a typical loan. This is not your 4.5%, 5% rate. Because the property is not livable and functional, the rates are going to be somewhere between 9 and 12% interest only on that payment. So let's just take an average of 10% interest only. And it's a $70,000 loan. You're going to be responsible to pay $700 a month during the renovation and getting the property leased so you can come to a bank such as us to refinance that mortgage.
Okay, so you can help on the refinance side. What about on the construction side? Where do people?
I have plenty of referrals. I could refer them to somebody that has been forwarding, scenarios for me to refinance. So it won't be a problem.
Okay, so you can still get people through the process, get them the proper, team in place to get those loans done and that financing, right?
Absolutely.
Okay, fantastic. So about 20% they got to bring to the table plus the closing costs, if they're going to flip it.
Yes.
Okay. What about people that are going to
hold it?
Or hold it.
Hold
Oh, okay. I'll hold it. So that's my next question. What about people that are going to buy and hold? Like they intend to invest in, we get a lot of people buying twins or multifamilies, and it's just really meant to be a long-term investment for them. They're going to fill it with tenants. Maybe it's part of their, eventual retirement plan in 20 or 30 years. Maybe it's something that they're using to build wealth and income for their kids. What about financing for the buy and hold people that are buying rental properties? What do you do there?
In that circumstances, we're allowed to go up to 75% loan to value based on the appraisal value once the place is stabilized and rented. Now, if it's under the name of the LLC, we can still go up to 75%. With our bank, we're limited on cash out, meaning that getting more than what you owe in those circumstances under the name of the LLC. In your personal name, if the property is stabilized, we can go. This is the difference between a residential loan in your name and a portfolio loan in the name of an LLC. The LLC, there is not really a seasoning process, meaning time of ownership, to be able to refinance out of a construction loan into a stabilized loan. If you're buying it cash, renovation and purchase, you're going to have a lower loan to value based on the LTV, probably anywhere between 65% and 70%. But if we're just refinancing your mortgage that you have from a construction lender, we can refinance that rolling closing costs as long as it's under 75% loan to value. Now, in your personal name, there is a seasoning requirement of 6 months to be able to refinance a mortgage, a construction loan, into a stabilized loan. The difference in amortization of years, the LLC loan would be 25 years on average. The loan amortization in the personal name would be 30 years.
Okay. Is that like the typical 30-year mortgage that you see people with, but an LLC would be 25 years?
With Firstrust Bank, yes, on average.
Okay. Okay. So we get a lot of questions from people about, um, the loans. And when people come to me, often they've already built up a portfolio of properties. Maybe they have 5 or 6 properties and they have them all in their own name. And
Hmm.
usually they do that because they've gotten one of those, low interest rates that they qualified for based on their personal credit. But from the liability side, on my end, like I don't like to see that because, now they're exposed, their name's on the deed. So they always come
Hmm.
in asking, well, how could I put this in an LLC? And most of the time, I can't move that property into an LLC because it's going to violate their mortgage clause. So they try to think of a way going forward as to like what kind of financing they're going to use. So if someone wants to put the property in an LLC, is that a different kind of financing than they've probably been using, with the low interest in their own name? Like what
It's,
sort of things should they ask, about that?
well, good question, because if the borrower has stabilized, rents, and they have decent credit scores, moving around 680 or plus, like 700 score, we could typically just refinance the property out of their name into an LLC. Now, the catch would be, there's a couple catches. One would be that there's transfer tax depending on what county you're in. Okay, so you're going through a full refinance to take it out of the personal name and put it in the name of the LLC. It also has to make sense bankability wise, because you don't want to put somebody in a bad debt to income circumstance. So you got to evaluate that. But what's one good thing is they could treat that property now as a business and issue business tax returns and issue a K-1, where that property and that mortgage is not reporting to their credit personally. Okay?
Mm-hmm.
So you could eliminate a lot of debt to income in the personal name after you build up a decent portfolio in your name and start moving them over into the portfolio loan, because under your personal name, you're only allowed to have a personal home mortgage plus 9 other mortgages. One could be a secondary, and then 8 investment properties. So it kind of gets them back to ground zero to start over again if they want to buy more properties in their personal name.
Okay.
So it gives a lot of leeway to an investor. They have options at that point.
Okay. What if they have multiple properties and we talk about the liability and we decide that, for best protection purposes, they might need multiple LLCs? Like, how complicated does that get on the financing side?
It would get more complicated on their side with the CPA if they don't understand how to issue K-1s and personal returns. Business returns. I'm fine with it if they want to use a special purpose LLC for each property.
Okay. So for the banking purposes, it's not a big deal, but for accounting, they need to keep all their books straight and their records and expenses associated with each LLC.
And that question comes up often, Sarah, and I refer them to several CPAs I know that are familiarized with real estate investing business.
Mm-hmm. Yeah, exactly. I always keep a list of CPAs that I know have helped investors and really understand, the property holdings and how to run them as a business. And I think that helps people a lot.
And there's another thing. You don't want, see, this is what I see. I see CPAs making certain CPAs just making a lazy move. They'll combine the LLC income into the personal income and merge it all. A real estate mindseted CPA will issue a business return and a K-1 to be placed on the personal return.
Mm-hmm.
Where that's much smarter. That's how you're really building out a business in real estate.
Exactly. Yeah. I try to get my clients to, a lot of people don't think of these real estate investments as a business. They think of it as any other kind of financial asset they have, like just another bank account or, a CD or some stock they own. And it's really not like that. Like, you really should treat it as a business and set it up that way and get everything flowing, to really make it like a business, keep yourself protected, and also keep all your financial situation, your accounting, separate and in good order there.
Yeah, you definitely want to keep church and state separate. And a lot of CPAs are not familiarized. They'll take the shortcut, try to give the client more deductions, which is unnecessary because you need to show income to show a growing business. And I like I like the accountant that understands that. So I like that accountant because I work well with them, especially when it comes time to putting a loan in the name of the LLC and or the personal name. I know what I'm working with.
Yeah, I agree. So you always have a good set of referrals as well, right? To refer people to for that kind of help.
I mean, that's what I do all day is building my power team.
Yeah. So what other kinds of advice or what other tips would you give to an everyday investor that's, just starting out with financing, or, is the person that has like a number of properties in their personal name and now they're really thinking of going LLC? Any other tips?
Well, I mean, you have to make sure these properties, if you're looking at it from a 30-year and it's in their personal name, you
Hmm.
got to make sure it's going to work at a shorter amortization, more of a 25-year. And by the time a client is thinking about moving a property out of their name into an LLC, they have a several years ownership. So there's built-in equity. So by moving it over, it might not even make any impact on your principal, interest, taxes, and insurance overall. And your rent your profit or NOI, meaning net operating income, stays the same. So you got to really look at, can I put this into an LLC loan, which the amortization potentially could be less.
Okay. Yeah, I think that's a great tip. One other question that I get from people is, a lot of people come to me with this plan, they have one property, maybe they paid cash for it. And what they want to do really is take some money out of that property. They want to put financing it because they're going to go take that money and they're going to go buy more properties with it.
Okay.
How about in that scenario, do you have any type of guidance or tips for people?
My question would be back to you is, are we talking about a property worth more than 150,000? Is it only worth 100,000? Because some banks are not friendly to putting just a line of credit on the property as an investment property. They have certain loan amount requirements. So it depends. But they can literally do a cash out if it's owned long enough from a seasoning perspective. If it's a full cash out, it would be 1 year seasoning under the personal name. In the LLC, it'd probably be a lower loan of value based on appraisal value, but as long as the place is leased, it could be looked and considered.
Okay.
So it's all about loan amount too.
Mm-hmm. Okay. So I guess the takeaway is like, make sure you have tenants and, some income coming into these properties
Solid
as well.
leases, yeah. I mean, show it like a business.
Mm-hmm.
Don't show it as a loss.
Yeah, I think that's great advice, especially in the property investing world. Okay, well, thanks so much today for your tips. And is there a website or LinkedIn page you'd like to give people to be able to find you if for
Sure.
more information?
Well, on LinkedIn, I'm Joseph V. Scorese. On Facebook, I'm Joseph Scorese. And Firstrust.com, you could look up loan officers, and I think I'm the man on the bottom, last name, I think. So if you look up loan officers under the Firstrust.com, that's one T in the middle, Firstrust, technically.com. My information is there as well.
Okay. All right. So if anybody has any financing questions, you'd be a great resource for them to contact.
Thank you. I really appreciate the time, Sarah.
Okay. Thanks so much, Joe. And we'll talk to you soon.
Great. Have a great day.
All right. Thanks. You too.